Hey guys, my name is Patel and welcome back to my channel Patel in Canada. In this video, I will give you all the information about mortgages in Canada. I hope you will find this video valuable, so don't forget to like my video and subscribe to my channel. So, the mortgage is a loan to buy a home. When you have a mortgage on your home, that means the bank or lender is also the owner of the house. If you don't pay the mortgage, then the bank will sell off your house and they will recover their money. When you paid off the full mortgage, you will have 100% ownership of the house. Mostly people do not have enough cash to pay for the house and therefore they need a mortgage from a financial institution or private lender. As purchasing a home is the most significant expense of your life, it is very important that you understand how the mortgages work in Canada. Every mortgage is different, but they all have similar components that you need to be aware of and understand. There are 5 different components of the mortgage. Number 1, interest rates. Number 2, type of mortgage. Number 3, closed and open mortgages. Number 4, amortization period and terms. Number 5, payment frequency. Now let me explain all of these components in detail for better understanding. The first one is interest rate. When people think about mortgages, the first thing that comes into their mind is the interest rate. The interest rate is the cost of borrowing. For example, let's say the current interest rate is 2%. That means you would pay $2 for every $100 borrowed. When interest rates are low, the cost of borrowing is cheaper. That means you would potentially borrow more money. On the other hand, if the interest rates go up, then your house buying affordability will decrease. The interest rates offered by the lenders are based on the prime rate from the Bank of Canada. The second component is the type of mortgage. When you are getting a mortgage, you will have 2 options available: fixed and variable. With a fixed rate, your interest rate stays the same for the entire length of the term. That means you are locking in your rate so you will know exactly what you are paying. Variable rate mortgages offer a discount that is prime minus X percentage, which means you are paying less than current fixed rates. So, if the interest rate go down, then you will pay less. However, if interest rate goes up, then you may end up paying more than what you would have paid with a fixed rate mortgage. Some lenders will allow you to convert your variable rate mortgage to a fixed rate. Both of these types of mortgages have their own advantages and disadvantages. So now let's see the third component, closed and open mortgages. Just like fixed and variable options, you will also be required to select between closed and open mortgages. Most of the homeowners choose a closed term mortgage because it offers lower interest rates. But you will have to pay penalty if you break the mortgage before the end of the term. However, closed rate mortgages give you the prepayment privilege that allows you to make additional payments without any penalty. Open mortgages is a good choice if you think that you will be able to repay your mortgage in the near future. Here, you can repay either part or all of the mortgage without any penalty. The fourth component is the amortization period and term. As the mortgage amount is typically huge, they need to be paid back over many years. This is known as the amortization period. Mostly, new homeowners will be able to get a mortgage with an amortization period of 25 years. But in some cases, you can get a 30-year amortization period. Longer amortization period will lower your monthly payments, but it will also increase the total amount of interest that you are going to pay over the life of the mortgage. The mortgage term is how long your mortgage contract stays with the bank or lender. Most people go with a 5-year term, but you can find terms ranges between 1 to 10 years. Longer term will usually cost more, but the rate you get is locked in. The short term is appealing for the lower rates, but keep in mind that when you renew the new term, then you have to accept whatever the rates are available at that time. The fifth component is payment frequency. While setting up your mortgage, you will have multiple payment frequency options available, and this will determine how much you pay and when you pay. For example, in the monthly options, payment happens every month. In bi-weekly option, your monthly payment is multiplied by 12 and then divided by 26, and you make that payment every other week. With the accelerated bi-weekly option, your monthly payment is divided by 2 and then paid every other week. In weekly option, your monthly contribution is multiplied by 12 and then divided by 52, and you make that payment every week. The last option would be accelerated weekly, where your monthly payment is divided by 4 and then paid every week. Now, let's see the requirements for getting a mortgage. So, whenever you apply for a mortgage, the bank or lender will look for 3 major things. The first one is a good credit score. By checking credit score, the lender wants to ensure that you are creditworthy. The second thing is down payment. You need to have at least 5% of the purchase price as a down payment to qualify for a mortgage. The third thing is secured income, meaning you need an employment letter to prove that you have steady income and you will be able to keep up with the mortgage payments. So, if you meet all of this criteria, then you will be able to get the mortgage easily. Just in case if you don't meet all the criteria, you may still have other options available. Some lenders are willing to work with borrowers with a lower credit score, but you may have to pay a higher interest rate. Self-employed and low-income individuals can still get a mortgage, but they are required to prove their income or need a co-signer. Now, let's see how much mortgage you can afford. So, when you apply for a mortgage, the bank or lender will use 2 calculations to determine the maximum amount that you can afford. First one is GDS, or gross debt service ratio. The housing cost, such as your mortgage, heat, condo fees, and property taxes, makes your GDS. This amount should not exceed 32% of your pre-tax income. The second calculation is TDS, or total debt service ratio. So, when you add any other additional debt payments, such as student loan and credit card debt, to your GDS, then it will give you your TDS. The TDS ratio should not be more than 40% of your pre-tax income. So, this is how the mortgage works in Canada. There are lots of factors involved with the mortgage approval, and therefore it is a time-consuming process. Make sure that you shop around to check which lender has the best mortgage offer available for you. You can find few links in the description below if you would like to know more about mortgages. Thank you for watching this video, and be sure to like my video and subscribe to my channel. Let me know your thoughts and questions regarding the mortgage in the comment section. Thank you again, and I will see you guys in my next video.